7th August 2024, the Bank of Uganda Monetary Policy Committee, MPC, reduced the central bank rate, CBR, by 25 basis points to 10%. In the 12th month to July 2024, domestic inflation continued to moderate, with annual headline and core inflation averaging 3.2% and 3% respectively, below the medium-term policy target of 5%. This is due to the fading impacts of global shocks like the war in Ukraine and COVID-19, the tightening of monetary policy early this year, and the exchange rate that has stabilized with a bias towards appreciation since March 2024. The relative stability of the shilling against the US dollar has benefited from the recent CBR increases and inflows from coffee exports owing to the favorable international coffee prices. Nonetheless, both annual headline and core inflation edged up slightly to 4% from 3.9% and 3.8% in June 2024, respectively. The increase in inflation was largely due to the increases in passenger transport, accommodation, recreation, sports, and culture services inflation. The increase in the services inflation was 6.5% in July from 6.1% in June 2024. Looking forward, the Bank of Uganda expects inflation to be below the 5% target in financial year 2024/25, broadly reflecting stable demand conditions, lower imported inflation, and exchange rate stability. The inflation projection has been revised slightly downwards relative to June 2024 forecast round, largely due to a lesser depreciated shilling exchange rate. However, we expect inflation to continue rising moderately in the next 4 months due to seasonal factors, but stabilize around the target of 5% by the first quarter of 2025. There are, however, persistent uncertainties around the inflation projection, including the effects of a possible escalation of the ongoing geopolitical tensions in the Middle East, potential energy price hikes, and favorable weather patterns affecting food crop production, and a stronger than expected path for domestic demand. In addition, the signs of lingering inflation in other parts of the world and heightened volatility in both capital flows and the exchange rate could result in the stronger depreciation of the shilling exchange rate and therefore higher inflation than currently assumed. Conversely, the continued unwinding of the past shocks to energy and other imported goods prices may moderate inflation. The risks around the projection for inflation are judged to be balanced by several external shocks. GDP growth picked up in the last 2 quarters of financial year 2023/24, with an average growth of 6.7% year on year, compared to a growth of 5.3% in the first 2 quarters of the financial year. The pickup in growth was broad-based across all sectors. There are signs that the continued recovery in real incomes and rising confidence are beginning to pass through to stronger consumption despite the tight monetary policy. Indeed, the high-frequency indicators of economic activity indicate improvement in business conditions, as shown by the sustained expansion in output and new orders. Economic growth for the financial year 2024/25 is projected at between 6% and 6.5%. Over the medium term, economic growth is projected to be above 7%, supported by stronger private sector investments and government interventions, especially in agriculture and the global economic growth recovery. However, there are vulnerabilities to the growth outlook. Internationally, there remains a continued risk of higher commodity prices and a disruption to trade flows associated with developments in the Middle East and other significant geopolitical uncertainties, which could lead to weaker global economic activity and stronger inflationary pressures. In addition, the re-emergence of protectionist policies could add pressure on the international trading system and weigh on domestic growth through lower exports of goods and services. Economic growth could also be lower if the growth in private sector credits slows further due to higher costs of borrowing and higher domestic borrowing by the government. Additionally, a stronger shilling depreciation could weigh down on on domestic demand, since capital and other intermediate goods account for 75% of imports. On a positive note, more favorable weather conditions leading to good food crop harvests, higher government and private sector investment in the extractive industry, and effective government intervention programs could boost economic activity. Furthermore, if the world economy grows more strongly than currently projected, rising net exports would boost domestic growth than currently expected. The risks to this forecast are assessed to be broadly balanced. The MPC noted that although risks of higher inflation remain, the adverse impact from the past external shocks has abated, and there has been some progress in moderating risks of inflation persistence. Therefore, it was appropriate to reduce slightly the degree of monetary policy restrictiveness. As a result, the MPC reduced the CBR by 25 basis points to 10%. The ban on the CBR remains at +/- 2 percentage points, and the margins on the CBR for the rediscount and the bank rates at 3 and 4 percentage points respectively. As a result, the rediscount and the bank rate will reduce to 13% and 14% respectively. Given the balance of risks, the MPC noted that a cautious easing of monetary policy is warranted in support of the objectives of containing inflation around 5% policy target and economic growth to levels consistent with socio-economic transformation. Going forward, Bank of Uganda will adjust its policy stance informed by incoming economic data with a view to maintaining a low and stable inflation environment, which is necessary for sustainable economic growth.